Thanks for joining us on Power Lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Dugal. Let's get straight to the headlines. Indian markets trade marginally higher. Pharma stocks are top performers today.
The RBI sets a March 2018 deadline for lenders to provide for bad loans identified under its second list of stressed assets.
The government is also mulling a ban on defaulting promoters from repurchasing their assets, which have been put on the block under the Insolvency and Bankruptcy Code.
Reliance Industries raises $800 million from the foreign bond markets at just over 130 basis points over US Treasury yields. That's a first by any Indian company.
Voices coming up on the show today. We've got a bunch of banking news. We'll get perspective on that from Hemindra, Hazari, banking analyst. Manish Sonthalia of Motilal Oswal raises concerns over financial sector valuations. A snippet of that conversation coming up. And Samit Ghosh of Ujjivan Finance says that there is no talks of acquisition by a larger private lender.
All right, let's talk about the markets first. Pradeep Pandya is standing by with a closer look of how stocks are moving today. RI leading the charts today.
Definitely, RIL is leading with that huge upgrade with 1,200 rupees price target. It was quite surprising. But in fact, RIL turned 3 days ago along with the markets, I would say, and has been actually quietly leading. It may not have appeared in the big movers tally, but being a heavyweight, it has really been driving this reversal in markets. And if you look at it, Nifty is kind of lagging the Nifty Bank and Mid-Cap Index, because Mid-Cap Index is almost at the all-time high, if you look at today's high. And also Nifty Bank made a new high 2 days back already, after immediately after that upgrade announcement came from Moody's. So Nifty is now inching up, and support is coming from RIL, is also coming from the pharma stock. So that is yet another sector which has turned positive now. If you look at it, a good news for Reddy's today. There was a news for Biocon yesterday. Looks like some of the headwinds have kind of at least slowed down, if not completely turned. And also, I think the most important worry that equity players had was crude, and it's holding on to a range. Market is waiting for the next meeting. So that is also positive for markets. IPOs are also doing well, like what has happened to HDFC Life Insurance. Today also this stock has moved up. So there are various sectors really supporting it. And some of the mid-cap numbers that have come off late have also helped, like the Merck Electronics is one stock to really watch out for in today's trade. Number has been much better than expected. So I would say now mid-caps are really kind of in focus. They are driving the sentiments up. Focus is completely there. And Nifty Bank has also moved up. Now it's for Nifty to really catch up with them and make a new high, which is around 150 points away from here. So let's see if that can happen in this series. That is the big focus of F&O traders now.
All right, Pradeep, thanks so much for that. About 0.5% higher on the markets at this point in time. The big story that we're tracking here today is the approaching deadline for the second list of stressed assets, which the Reserve Bank of India has asked banks to send to the Insolvency and Bankruptcy Code if they can't resolve it by the 13th of December. Vishnath Nair joining us on the phone line with exclusive news on what the provisioning requirements on this will look like and the deadline for that. Vishnath, what do you have?
What bankers are telling us, Ira, is that the RBI has asked these bankers to provide for the second list by the 31st of March 2018. Now, this is an accelerated provisioning when compared with the first list, where they had about 3 quarters to provide for the assets which were listed. Remember, that list was also a much bigger list. There were 12 cases, but represented about 25% of the gross NPAs of the banking system. So that's a pretty large sort of exposure that they had. In the second list, though there are 28 to 30 cases, the total outstanding exposure is still less. So as such, the provisioning requirement might be lower. But the time that they've been given, that is very less. They only have time till the end of the financial year. The government will also be looking at these things, because of what they've asked the bankers to do is send them whatever provisioning requirement they have, so they can assess the recapitalization that they need to do this financial year, depending on the bankers' needs.
Vishnath, a quick follow-up question. So, the first round of accounts meant a solid knock for some of these banks. The second round will probably mean a slightly lesser one, because some of the banks that you have interacted with over the course of the earnings season have said they've started the process at least?
Yeah. So, for example, State Bank of India, the largest, have an exposure to 20 in the second list. They have also started for the second list. The provisioning is not on. But it's also the Union Bank.
We seem to have got Vishwanath on a really bad line. We'll try and get back to you in a bit, Vishwanath. But
let me just sort of sum up what he was saying. Since we couldn't hear him too well, essentially what Vishwanath has found from his banker sources is that banks will have until March to provision against the second list. The second list was a larger list in terms of the number of accounts. It was almost about 30 accounts. But these are not cases that are as large as the first list, which was the 12 accounts.
Right.
The 12 accounts accounted for almost a quarter of the NPA pool. And the second thing is that some of the banks, the more prudent ones, have already started provisioning for these accounts because they knew that they may not be able to resolve it. This is important from a cleanup perspective, but as Vishwanath was also pointing out, important from the recapitalization perspective because the government needs a clear sense of how much capital each individual bank needs.
All right. So, but there's another one that's coming from the government. This is 11 months after insolvency and the bankruptcy code came into effect. The government is now setting up a 14-member committee which will look into the possibility of barring defaulting promoters of stressed assets from the auction process. Corporate Affairs Minister PP Chaudhary told Bloomberg News that concerns of all stakeholders will be taken into consideration. For more on this, Shruti Srivastav joins us from Delhi. Shruti, thank you for joining in. What is the thinking in the government? Many of these cases, promoters want to throw their hat in the ring and come back. What's the government inclined to do?
Thank you for the question, Harsha. Yes, there have been concerns on defaulting promoters trying to wrest control of their companies which are facing insolvency proceedings. Now, there are 12 large companies which are on the block right now, and the lenders have already invited bids from interested parties. Reportedly, many of these promoters are trying to bid for their companies which are facing insolvency proceedings. It is keeping this in mind that the government has formed a 14-member panel basically to look into all the issues and concerns which have been raised by the stakeholders. Now, Corporate Affairs Minister Mr. PP Chaudhary has told us in an interview that all the stakeholders which have raised similar concerns, all their concerns will be addressed by this panel. Now, there is a thinking in the government that yes, the willful defaulters should not be allowed to bid for their assets. When asked about this question, Mr. Chaudhary said that yes, willful defaulters may not be allowed to bid for the companies which are facing insolvency proceedings. However, only when the panel gives its report after 2 months will the government take a final call on this.
Right, Shruti. I'm just going to make a quick distinction, a very important one, between willful defaulters and defaulters.
Yeah.
I think it's much easier for them to bar willful defaulters from coming in as part of these bidding processes, but to bar defaulters, which would mean anybody who's an NPA, it'll be a tougher and a more important decision. But Shruti seems to be suggesting they'll at least talk about all of these aspects as part of that committee.
All right, Shruti, thank you so much indeed for joining us. Let's move on now, and there's another piece to the story. And this is, if there is one banker who's looking to make most of this opportunity, it's Uday Kotak. In a conversation with Bloomberg News, he says, and I quote, "The whole insolvency and bankruptcy process is a once-in-a-lifetime event. You could actually get assets that would give you disproportionate returns for long periods of time." We're joined by Anto Anthony of Bloomberg News, who did that interview with Uday Kotak. Anto, thank you for joining in today. Let's broadly first, when you spoke to him, what's the sense that you got? His views on bad loans, and why does he think this is a great opportunity?
So Billionaire Kotak stands out apart the Indian bankers because he has been buying bad loans all through the last more than a decade on his bank balance sheet. So with this 207 billion bad loans or impaired assets in the banking system, he's looking at picking it up through the various alternate investment funds that he controls. If an account hasn't already moved into NCLT, he's looking at buying those loans on his bank's balance sheet. And also, because he has a very robust advisory business, he's looking at engaging with maybe the bidders for these 52 companies on an advisory role, so that he can work with the bidders to pick up the stake in these companies.
On the specific point of defaulting bidders, what's his view? Do you think does he think that the defaulting bidder should be allowed to bid?
As Ira just mentioned, he believes that barring the willful defaulters would be an easy thing to do. But then the distinction between willful defaulters and defaulters is a very thin line in India. And he's saying that maybe a forensic audit, because most of these accounts has already gone through one round of forensic audit. He's saying that maybe another round of forensic audit is needed to see whether the promoters or the founders has diverted these funds in any way, or whether they are in a position to repay the loans, but they are not doing that. So the sense that we are getting is that he's very clear that willful defaulters shouldn't be allowed to bid, but then and forensic audit has to be done in all these 50 cases to make sure the promoters who have defaulted are not willful defaulters.
How much of a haircut do you think the banking system is expected to take? What is Mr. Kotak's view?
So that varies across the board, but on an average, he says that up to 50 to 60% haircut is what bankers should be prepared for, because in some of these accounts, there have already been problem loans from 2010 onwards. And various options offered by RBI. So in those cases, the haircuts would be way higher. But on a ballpark figure, he's expecting 50 to 60% haircut.
If I can, just a broader view as well. What's his view of increasing competition now that all these banks are going to be recapitalized? Does he still think that he can hold preserve on some of these verticals, or what's the sense?
So the Kotak Mahindra group, because the way in which it is structured, it's present in all the financial services sectors.
Yeah.
And the Kotak thinks that these banks being recapitalized will obviously increase competition, but then the view that he brings in is that the competition has to be looked in at a more holistic way, because the competition has been going up even from the fintech companies and so on. But overall, the sense that he gives is that as long as the state-owned banks are chasing returns, risk-adjusted returns, and as long as the competition is not just on pricing, then it would be good for the banking industry, and all the banks should fare better.
All right, Anto, thanks so much. Great conversation, and you can go to bloombergquint.com to read the full details of what Mr. Kotak had to say to Anto. But we're trying to now bring back all the elements of banking that we have spoken today and try and get an analyst perspective on this. Hemindra Hazari, independent analyst, is joining us on the phone line. Hemindra, good afternoon. Thanks for joining us. I want to start with the first story that we were talking about. Vishwanath had heard from his banking sources that banks have been asked to finish the provisioning on the second list of stressed accounts by March. A short period of time, but you think it should be done in any case, so that by the time you get to the next fiscal, you have a slightly cleaner book to go ahead with?
No, that is true, because the market always likes to see a full cleanup and the house being clean. And from what we've seen, at least even in the case of Union Bank, when they showed accelerated provisions, the market actually took it in its step. So I think the market always likes to see a very clean balance sheet, and therefore I think in one way it is very heartening that there will be full, at least a closure on all these bad debt problems, because we have various estimates going on what is the actual state of the bad loan situation, and it causes a great deal of uncertainty. So once we have this, at least the view will be, at least for the large corporate accounts, there has been a massive cleanup.
Mr. Hazari, what is your sense, based on the reported numbers, of course, as to what the provisioning gap currently is? Because even net NPAs in a lot of these banks are fairly high. So, I mean, just goes to show that there is still a fair extent of under-provisioning on bank balance sheets.
No, fair. We'll have to now see, because, the whole approach of the government and the RBI is that for all these large corporates, the banking sector should take the hit. And one should not really use your enforcement agencies to go after these large corporates or siphon monies. Therefore, in fact, you're giving effectively a large subsidy to the large companies, because we have seen really no major attempt by the enforcement agencies to go after the money siphoning which has been done by these large corporates, by these willful defaulters. Therefore, it appears that the National Exchequer is now standing by to really bail out the large corporates. And I think this is another agenda which must be publicized, because the hit is really being taken by the bank, and in fact is being taken by the Exchequer.
Mr. Hazari, this is Harsha joining into the conversation. The other story that we put out is the fact that the government is apparently forming a committee to mull over whether a defaulting promoter can be allowed to join the bidding process at all. What's your view on this?
See, I think for one, you have to have a very thorough forensic audit done to find out where there has been money siphoned off. In my opinion, in most of these large corporate accounts, there has been massive siphoning off on monies. And in fact, the Wire has already carried a major article which actually shows what is going on. So therefore, in my view, once you have a defaulter and a willful defaulter, he should not be allowed, because then not only are you giving them a huge haircut at the cost of the exchequer, but you're allowing him to again retain and regain control so he can continue with his daily siphoning of monies.
No, sorry, Ira was just pointing that out exactly. The distinction between a defaulter and a willful defaulter. What if there is a genuine corporate who wants to come back into the business, throw his hat in the ring and join the bidding process? In principle, should he be given a chance?
So I think you have to see now what exactly. That's why I think that forensic audit is very important. If the forensic audit shows that he has not siphoned off, in my view, most of these large accounts, there has been huge siphoning off. So I really don't see in these large corporate accounts to give it back to the existing management, because they've clearly been failures. You cannot keep blaming industry cycles. It just shows if it is not siphoning off, it is incompetence, and neither should be rewarded. So in my view, for these large accounts which we are talking of, I think the existing promoters and management should not be given a second opportunity at all.
Mr. Hazari, last question and sort of rounding off to the third part of our banking chat today, which is, Uday Kotak saying that this is a once-in-a-lifetime opportunity to buy some of these stressed assets. But, we don't know how quickly these assets will get sold, except for a couple of large steel accounts where we've heard news that there are bidders, international bidders included. How quickly these get sold, what pricing these get sold at, that's still a big unknown, and we'll probably, we'll only get clarity midway through next year on that.
Now, what you said is very correct, because so far what we have seen from the insolvency, the kind of quick resolution one thought would come about has not come about, which was my expectation also. So it appears that, as what I said earlier, that the banking sector is going to take the hit really. And then subsequently, we are going to see whether you can get a new management, whether the existing management can be given a second chance. But the real issue is that the exchequer is giving a huge subsidy today to these large corporates. Basically, the banks have to provide for the losses, and these large corporates appear to be getting away scot-free.
All right, Mr. Hazari, thank you so much for joining us on the phone line, giving us perspective on all of those big banking stories. Moving on from stressed corporates into a corporate which is anything but stressed. The best of Indian credits out there. We're talking about Reliance Industries. They've raised an $800 million 10-year bond overnight. The issue opened yesterday. It closed late night yesterday. The reason it's remarkable, or it's worth noting, is the fact that they managed to get this money at the cheapest rate that any Indian corporate has managed. So they priced that 10-year bond issue at 130 basis points above the 10-year treasury. They actually, the issue went to market while the excitement around India's credit rating was still there. Remember, Moody's came in with that announcement on Friday. Reliance was all ready. This is a refinancing. Reliance was all ready, and they went in on Monday. They opened the issue. It was closed by the end of the day. They had strong demand. Apparently, almost a $2 billion book had been built for this $800 million issue. They had fairly diversified geographic demand as well, and they finally raised it at 130 basis points. Just to give you a slight comparison, in 2015, when they had raised 10-year money, they had raised it at 240 basis points above treasury. So, just for Reliance Industries alone, you can see the kind of differential in cost that has happened over a 2-year period. And this is a fabulous chart, which actually Andy Mukherjee of Bloomberg Gadfly has put in his column, which is on the Bloomberg Quint website. He points out, Harsha, the ironic diversion between Reliance Communication bonds, which is Anil Ambani owned, and Reliance Industries bond. We all know that because of the default on Reliance Communication bond in the foreign currency bond market, they've become a pariah of sorts. And here is the other brother who goes in and manages to raise money at the cheapest rate that any Indian company has raised till date.
Interesting start that. More Reliance stock. Goldman Sachs has raised its target on the Reliance Industries stock by 26% and added to its conviction list. The brokerage seems positive on the counter, expects EBITDA to double over the period of next 3 years. Soumit Sarkar is standing by to tell us more on why Goldman is so bullish. Soumit.
So Goldman Sachs has maintained its buy rating and have hiked the target price to 1,205 from 960. Now this is the second highest target price on the street and it's way ahead of the consensus target price of 950. So why they have done this? Because in Asia, Reliance Industries is the best large cap downstream company. And why is it the best large cap downstream company? Because it has sector leading earnings growth and a strong competitive position. Now if you see year to date, the stock has done more than 60%, but it is mainly on the back of its telecom business, and that's the reason Goldman Sachs still believes that the core refining business of the company is still trading at a discount to its peers. Now they're expecting the company's EBITDA to double over the next 3 years from $7 billion in financial year 2017 to $14 billion in financial year 2020. They are also expecting the company's cash return on capital invested to revert back to its historical highs, and they are expecting the company to be free cash flow positive going forward. Now the company has been negative on the free cash flow side for the last 5 years, but going forward they're expecting the yield of the company to be around 6% by financial year 2019. Also they're expecting the free cash flow of the company to be around $6 billion for financial year 2019 and for financial year 2020. Now also they are saying that the capex cycle of the company has come to an end, and on the back of this they're expecting the petchem business of the company to be the key growth driver going forward on the back of higher volumes. Also the refining margins is expected to outperform when it compared to its peers on the back of its highest refining complexity, operational excellence and better cost position. The telecom business of the company is expected to contribute positively by financial year 2019, and they're expecting Reliance Jio, that is the telecom business, to have a revenue market share of around 20% by financial year 2021. Finally, on the valuation side, they are saying that the refining, petrochemical and telecom will be the key drivers. They are using a 10% conglomerate discount, and they have increased the target price because they have hiked the enterprise value to EBITDA multiple to 8 times from earlier 7 times.
Soumya, thank you for that. I'm going to stick with the RIL story. Ira, take a look at this chart. You know, this sort of tells you a story. It's a plain vanilla chart that compares the Reliance stock performance year to date to the Sensex performance year to date. The blue line is the Sensex, and the Sensex has had a decent year. It's about 26% gain. RIL is up nearly 72% year to date. Now, on the left corner of the screen, you can see that jump in the month of February. That was the day when they actually announced that Jio is going to charge monthly tariff from April. Yeah. So when that announcement was made, there was a jump, and since then there's no looking back for the stock. It's up 72%. Tells you a story of how well the stock is performed vis-a-vis the Sensex, and explains why the conviction that Goldman Sachs is not just on the core oil and gas business, but also on the telecom story.
And if that same comparison chart had been stretched out to 5 years or more than that, you would have seen that period of underperformance when RIL was in the capex phase, and it kept saying that this phase will pay dividends. There you go. Fabulous. We've got our team has pulled that up, so you can see that period of underperformance, and now it's just zoomed up. Fabulous.
Okay, a lot has been said about foreign investors selling Indian equities over the past few years. But while the secondary market may have lost its sparkle for FII, Shraddha has found out that what's caught their fancy this financial year. Shraddha, so what are they finding attractive?
Well, just to start off with, I just want to say that we're clearly talking about Indian equities here, and we're not talking about the foreign flows into the debt bit of it. So if you just look at the foreign investment into Indian equities via the secondary market in FY18, that is from April till date, you will see that there were significant or heavy outflows which totaled in the months of August, September and October, which totaled to about 39,000 crores in FY18 so far. There's been November has been a good month, but in totality, if you add this up, you will see that there was a net outflow of about 21,000 crores from the secondary markets. But if you look at the primary markets and the foreign investor participation there, the picture is completely different. In totality, they have invested about 72,000 crores in the primary markets since April. In fact, a lot of the flows came in earlier in the months of May, June and July, and then you also had good flows coming in September and October. Now do remember that when we talk about primary markets, we generally associate it with IPOs, but it also includes QIPs, OFS, etc. So this is the total investment coming in via all those routes, which is the primary market. So we also have to remember that 2017 was an extremely buoyant year as far as IPOs are concerned. About 32 IPOs have come out in FY18 so far. Also, there were 4 large insurance IPOs. So if you look at SBI Life Insurance, that came in September, GIC came in October, and New India Assurance and HDFC Life both came in October. In fact, the subscription numbers for the QIB portion for HDFC Life stood at 16.6. Of course, we can't say how much of it came from foreign investors and how much from your domestic institutional investors, but it does sort of give you an idea about the kind of money that could have come in through this. But just to conclude, the two things that we can clearly say: one, of course, the fact that a large amount of foreign funds have moved in from the secondary markets to the primary markets, and this entire story about FIs having dumped Indian equities, when you look at the primary market, the picture really changes and says that it has not been the case.
All right, Shraddha, thanks so much for that. That's really insightful. That's data on how foreign investors have looked at buying in India. Now, after the Moody's upgrade, we at Bloomberg Quint spoke to a whole host of global investors to see if this has changed how they view India. Most of them said it doesn't change anything. They unanimously believes that the spate of reforms in the recent past are good and are bullish on Indian markets over the long term, but in the short term, the problem of high valuations remain.
We spoke to one of them, Manish Santalia, head of equities at Motilal Oswal Asset Management, however, believes that earnings will soon catch up with valuations. Financial sector valuations is what has him worried. Listen into that conversation.
Coming to yes, given the cash that is getting deployed in the markets, etc., it's difficult to find ideas at these levels, given the valuations and the earnings, whatever we are seeing all across. I mean, the current quarter numbers have also just ended. I mean, the September quarter numbers, and for the half year, I mean, it has been anemic growth. But let's hope that, the second half of the year, we should see some earnings pick up, and that would mean some decent earnings growth from a YOY perspective, FY18 to FY17. I mean, that should lend some support to the markets.
Okay, as you said, you have been trying to get some foreign investors in, but most of the big FIIs that we have spoken to of late, they find India relatively expensive. Are you really able to get capital from overseas?
No, it's been a tough call. Yes, the concerns are on the valuations, and because their money is fungible in emerging markets, so you'd have a South Korea or let's say Malaysia, etc., which is far cheaper than India. For a decent amount of growth that these economies are also presenting in the stock-specific companies, you have decent stock-specific companies, reporting something like 18 to 20% sort of a growth, and the P multiples are very reasonable. So their capital being fungible, I mean, India is definitely out of place as far as the radar for their capital is concerned. But what they are saying actually is that we would wait for the earnings to pick up, and then we'll take a call again, because India's story, a $2.5 trillion economy seems much more structural than many of the smaller emerging markets. So demonetization, GST, these are things which would have disrupted earnings, and they were having a wait and watch approach. Maybe they are keeping a wait and watch approach even now. But I mean, the thing to watch out for is the earnings momentum to pick up, and maybe then they will start looking at India.
Manish, if the last 3 or 6 odd months, if there is one pattern that is emerging, is that a lot of businesses or a lot of themes wherein earnings were absent hitherto and are now starting to come back are making those extended moves. We've seen that happening with real estate, we've seen that happening with mid-cap IT, we've seen that happening with select infra names as well. Is that a pocket that you would now start going down to? Because from whatever little that I know, you've been betting on the good businesses, established businesses, not looking at those gruesome businesses. Are you tactically putting in some money to work in areas where earnings recovery might be happening, businesses which hitherto were probably not looking all that exciting, but the cycle may be turning around?
Yeah, so our style of investing, we are not going to compromise on quality. I mean, that is for sure. But having said that, we are not averse to looking at any business per se, and that would include infrastructure companies, etc. So, what we would watch out for is what the margin profiles are, whether the company is getting advance against the orders, what is the working capital cycle, and so on and so forth. And we like a few companies in that space. But coming to a point whether, these are the under-owned sectors in the markets, And once the earnings cycle starts to pick up, and this is extrapolated from how we saw the last earnings cycle. Today we have around 35-36% of market invested in financials, and it's an over-owned sector. I mean, my sense is that over the next 1 year, maybe financials are broadly going to underperform, and you have some of the under-owned sectors, so-called hated sectors like IP, pharma, being under-owned and fundamentals being not that bad, and the valuations being what they are, almost at rock bottom levels, and infra space, etc., totally overlooked. I mean, these may be the spaces, the industrials, they may just find favor and may outperform the markets over the next 1 year.
We slip into a short break here on Power Lunch. We'll come back on the other side. M&M becomes the first automaker to set up shop in Detroit in 25 years.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Just business news, we're news for business people.
Back on Power Lunch, let's take a look at the headlines at this hour. Nifty tests 10,350 with the Indian markets looking all set to post its fourth straight day of gains.
Logistic companies gain after they're included in the infrastructure segment list, giving them access potentially to a larger and cheaper credit pool.
Mahindra & Mahindra sets up facility in Detroit, making it the first automaker in 25 years to set up shop in the erstwhile mecca of car makers in the United States.
And German Chancellor Angela Merkel says she prefers fresh elections over heading an unstable government.
Good day for the markets so far. Navneet is standing by with a closer look at some of those movers. Navneet.
Well, Harsha, so far it's been really good. In fact, we've not only sustained the morning moves, we've built on more gains coming about for your benchmark indices, Nifty and Bank Nifty both. In fact, as we speak, I guess Nifty is almost trading at very close to its day's high. So 10,350 is the level. Sensex 2 is seeing gains of almost 0.5%. Bank Nifty is a little bit underperforming the benchmark indices, and the reason for that is the PSU banking index has been little weak since the morning session. But overall, the market breadth has been pretty positive. On National Stock Exchange, we've seen the advance decline ratio clearly being in favor of the advances, almost 2:1 there on your screen. And the volatility too has cooled off today. The India Volatility Index has seen cuts of almost 1.5%. In terms of sectoral indices, you've got the Nifty Pharma as well as the Nifty Media Index. These both are your top sectoral gainers. Among the Nifty Media Index, you've got stocks like Hathway, Sun TV, in fact TV18, all these stocks have seen good gains, alongside HD Media too has done pretty well. And the two themes which are working out, one of them is the pharma stock. All your pharma stocks in Nifty have been gaining in today's session. So look at stocks like Dr. Reddy's, Sun Pharma, Lupin, Cipla, or even for that matter, Wockhardt has registered gains of almost 4%. The other theme that's working out are the tea stocks. There is news that the prices have gone up. So you've got stocks like McLeod, Jayashree, Rossell India, as well as Goodray Group have registered strong gains, and the likes of Merck Electronics, which have reacted positively to its numbers. HDFC Life post the listing has only built up more gains. That stock's also seen gains of almost 10.5% today.
All right, Nami, thanks so much. That's the structure of the broader markets. One segment which has been, at least in conversation, has been the logistics segment. The government has granted a long-standing demand from the industry to give it infrastructure status. Somit Sarkar is standing by with a sense of who benefits and how they benefit. Somit.
So now what the government has done is they have now changed the earlier transport category to transport and logistics category and has included logistics infrastructure as an infrastructure subsector in this list. Now transport and logistics include roads, bridges, ports, shipyards, inland waterways, airports, railway tracks, etc. But what is new and what has now been added is the logistics infrastructure. So what does that cover? Now logistic infrastructure means and includes multimodal logistic park with a minimum investment of 50 crore rupees and a minimum area of 10 acre. Cold chain facility with a minimum investment of 15 crore rupees and a minimum area of 20,000 square feet. And also warehousing facility which with a minimum investment of 25 crore rupees and a minimum area of 1 lakh square feet. So what are the benefits that this logistic companies will get? Now this sector is now likely to attract more funding at competitive rates. Having an infrastructure status would also help the logistics sector get credit at marginally lower interest rate and on a long-term basis. Now this move will also give the sector access to large amount of funds through external commercial borrowings, and this move could also attract large debt and pension funds to invest in the sector. Lastly, it will also bring down the cost of borrowings for the developers. Now, why this move was needed? Now, this move was needed because the logistic cost in India is very high according to a McKinsey report. Now, India spends around 13% of its GDP on logistics, which is very high when compared to US and Germany, which are developed countries. Now, US spends around 9.5% of its GDP on logistics, while Germany spends around 8% of its GDP on logistics. Now, as logistic cost is high, Indian goods become less competitive in the global market. So, this move will not only help the logistic company get a credit on a easier basis, but will also make Indian goods more competitive in the global markets. So there are a bunch of companies that will benefit because of this, but to name few is TCI Express, Snowman Logistics, Hemindra Logistics, All Cargo, Blue Dart and Container Corporation of India.
Somit, thank you for that. Let's take this conversation a little forward with Shamsher Dewan, Vice President of Corporate Ratings at ICRA. Shamsher, thank you so much for joining us. So, materially, what does this mean for the logistics sector now that they've been given infrastructure status?
I think I agree with your colleague on most of the points. Granting infrastructure status to the logistics sector is a very positive move, especially in wake of the fact that the logistics in India is characterized by high inefficiencies, both on the transportation as well as on the storing and warehousing space. So getting infrastructure status will have multiple benefits. One of the prime benefits that we see over the near to medium term would be access to credit. Infrastructure companies will be able to raise not just loans on competitive basis, but for longer tenor. Secondly, infrastructure companies are also able to refinance their existing borrowings with some sort of specialized institutions such as the development infrastructure companies. It also opens up an opportunity for companies to raise foreign borrowings through the ECB route. So overall, I think it's a very positive move, especially for the value chain within the logistics, which focuses on asset-intensive business models.
Shamsher, can you explain this funding, cost issue a little bit more? Hypothetically, yes, they can raise money cheaper via ECBs, right? Domestically, would their rates come down? And if so, what is your sense? Would it be a 100 basis point differential, more than that?
See, I think, yes, it is true. I think both domestically as well as from foreign avenues, funds can be raised at competitive rates. Now, that's primarily to do with the infrastructure status. So companies will be able to raise funds from the banking sector, because it falls under the priority sector lending. So the infrastructure companies have the eligibility over there. So the extent of benefit could be between, I think, 50 to 100 basis points.
Okay, Shamsher,
But of course, the extent of benefit would depend upon the current cost of borrowings for companies. And as it is, I think the interest rates have fallen, and companies have over the last 1 to 2 years benefited from declining interest rates as such.
Okay, so would you look at this with this space? Would you review the space once again? Would this space get re-rated? Because obviously the financial will look different. They're able to access capital at a much lower price. Does that mean you see this entire space getting re-rated?
So as I said earlier, I think the prime benefit will come to companies which have an asset-intensive model. And by asset intensity, I mean companies which are engaging in developing warehousing infrastructure, multimodal logistics parks such as ICDs or CFS, or even, there is a lot of trust by e-commerce logistic companies in setting up fulfillment centers. So companies which are engaged in these areas would have better access to credit and at competitive rates. At ICRA, we have a stable outlook for the logistics sector, and I think that will hold.
Would you anticipate that some of the individual firms within that logistics sector would, there would be a move towards a higher rating, perhaps, if the funding costs fall, if cash flows improve because they can borrow for longer tenors? Would there be a slight tendency towards upgrades on some of these firms?
Well, it will be a very company-specific, decision. In rating process, not only just the cost of borrowing, but many other factors are considered. So it's a decision taken by our rating committees based on multiple factors. So I wouldn't really be able to comment on whether this particular instance can lead to rating triggers.
Okay, Shamsher, just a last question on the kind of growth that this segment has seen, the logistics segment. What are the numbers looking like? You've been looking at the sector over a period of time. Has growth in this segment picked up?
Yes, so we've recently reviewed the performance of companies during the H1, and I think there has been improvement in the growth momentum compared to the previous year, and that's been driven by sectors such as automobile, FMCG, even e-commerce side, though there was some softness there on a YOY basis, but still I think things are holding up. We have an overall outlook of 9 to 10% the near to medium term as far as growth is concerned.
Shamsher, we'll leave it there. Thank you so much indeed for joining us. That's Shamsher Dewan joining us from ICRA, talking about what this means for logistics companies and how does it change their credit profiles. Let's look at global markets right now. The euro weakened marginally against after German Chancellor Angela Merkel said that she'd rather go to polls rather than head an unstable government. Bloomberg's Bree Taylor now joins us from London to tell us how markets are reacting. Bree, thank you so much for joining in. We've seen the political stalemate continue. How are the markets reacting?
So we're seeing equities pointing downwards right now. They're in the red. The stock 600 is being dragged down by travel and leisure stocks. And we just saw the Asian markets up with the Chinese stocks rallying. And as you just mentioned, Germany remains one of our top stories here in Europe, with the Chancellor Angela Merkel saying she's prepared for another election to help break up the political stalemate. She made it clear in television interviews that she prefers new elections to governing without a majority. Now, this comes after, of course, on Sunday, Merkel failed to form a new government. And we're also watching the Turkish lira this morning, which weakened to an all-time low against the dollar. But right now, we're seeing the lira actually pare some of those losses after the central bank tightened liquidity. So those are the two stories that we're really focusing on here in Europe, both Germany and the Turkish lira. Back to you.
All right, Bree, thank you so much for that update. That's the European markets. Just a bit of more news on the global front. US President Donald Trump declared North Korea a state sponsor of terrorism, subjecting the regime to additional sanctions and reinforcing its status as an international pariah. Let's hear him out.
Today, the United States is designating North Korea as a state sponsor of terrorism. Should have happened a long time ago, should have happened years ago. In addition to threatening the world by nuclear devastation, North Korea has repeatedly supported acts of international terrorism, including assassinations on foreign soil. As we take this action today, our thoughts turn to Otto Warmbier, wonderful young man, and the countless others so brutally affected by the North Korean oppression. This designation will impose further sanctions and penalties on North Korea and related persons and supports our maximum pressure campaign to isolate the murderous regime that you've all been reading about and in some cases writing about.
All right, let's move on. Mahindra & Mahindra has set up a new manufacturing plant at Detroit in the United States, making the first automaker in 25 years to inaugurate a facility in the erstwhile hub of automakers in the US, the first Indian automaker, that is. They're going to be making off-roaders from there and also looking to enhance their tie-up with Ford to build electric vehicles. Alex is here with some more details. Alex, this is a big one. I mean, you haven't seen this kind of move for a very long time.
Well, I think more than a short-term perspective on this, you got to look at it in terms of long-term. So, what are we talking about really? The vehicle that they're introducing now, that they will introduce, will come in January. It's going to be a very low-volume vehicle that they're introducing. It's an off-road leisure vehicle that they're going to introduce. It's likely going to be called Roxor. But let's look at the announcement that they've made. They're talking about a facility that they've put up. The total investment is $230 million. But that also includes a warehousing and logistics operation as well as a prototype business. And they're talking about designing vehicles in that prototype business. So that's all told $230 million. The vehicle, like I said, is going to be an off-road vehicle, low volumes. But interesting comments coming in from Anand Mahindra, who was there at the facility yesterday at the launch. And he essentially said that there is a possibility of bringing in SsangYong vehicles, so SUVs, into the United States market, badged under SsangYong. So that would be a significant move. Whether this assembly facility is going to be used to essentially put completely knocked down vehicles into place in the US is a question that will be raised, and perhaps the next investment that will be made, which is what they said is $600 million between now and 2020, perhaps that's going to be made in line with what they plan to do next. Now, the Ford thing is another big announcement that was being talked about. At a recent conference to announce the earnings, the management essentially said that there are no new developments there. There are 8 areas where they're looking to collaborate. Electric vehicles is one of them. So it's not clear. What is clear is that this facility that's being talked about is not the second home base that Mahindra has desires to create, which is essentially, they had announced this a little while back, and they had said that they want to create an exact operational framework that they have in India, somewhere outside India, to reduce.
This has nothing to do with the relationship with Ford, this plant, I mean.
Well, there are parallels that are being drawn. There are, people are putting 2 and 2 together and saying that there could be something in the future. But as of now, it's a facility that they've put up. They're going to manufacture an off-road vehicle, which is essentially a leisure vehicle, so low volumes. They've also, over a period of time, created a design framework over there and logistics and warehousing facilities, because they've been burnt in the past in the States with regard to letting out that operational facility. So essentially that. Long-term view.
Long-term view. Thanks so much, Alex, for detailing that story. Let's bring the conversation back home. Dr. Reddy's Laboratories wants to invite the US pharma watchdog to its Dewan plant. The drug maker, which produces 2 of its key cancer drugs at this facility, is seeking a re-inspection after the US FDA issued a fresh establishment inspection report, which does not remove the import ban imposed 3 years back. Darshan Mehta is joining us with the details on that. Darshan.
See, basically, when this EIR came out, the stock did manage to surge because the street did assume that the facility has been cleared. But once you went to the finer details, it was just in terms of the procedural in nature. So basically, what the US FDA has said is that we are giving you an EIR, but that is procedural in nature. The status of the plant still remains. The warning letter still remains. The 483 still remains, and they are expecting that the US FDA will come ahead and inspect the plant in 2018. So nothing much changes. The products that are there from the Dewan plant will continue to remain. They can sell it, but the new approvals won't actually come in. So what happened was in 2015 November, Dr. Reddy got a warning letter for the Dewan plant, in which, and post that, there was this re-inspection that happened, in which there were 13 observations. So nothing seems to be working well for Dr. Reddy's. The only silver lining here is that if the FDA has given an EIR here, it actually gives an indication that Dr. Reddy pretty much will be saved from an import alert that could come in, and that is why the stock seems to be rallying in today's trade.
All right, 6% higher there on Dr. Reddy's Laboratories. Thanks, Darshan, for that. Bringing it to the finance space, Dewan Finance is in the midst of a transition to a small finance bank and is working on building both a deposit base and diversifying its loan base. In a conversation with Bloomberg Quint earlier today, Samit Ghosh, Managing Director and CEO at Dewan, said that the lender is focusing on getting savings accounts up to 20% of its deposit base, and it's also expecting about a 20 to 30% growth every year from here on for the next 5 years. Ghosh also said that rumors of a possible buyout of Ujjivan by a private bank like Kotak Mahindra Bank are quote-unquote fake news. Hear out that conversation.
You know, I mean, in terms of as a small finance bank, if you look at CASA, our focus is more on the savings because as you know, current account balances are largely from large corporates. True. And it comes with cash management services, etc. So which we will not have that much. We will have a limited amount of that where we are dealing with MSCs, etc., smaller businesses. So we'll get a relatively small portion of the current account. Yeah. But the savings account balances, obviously, we are focusing on. And I think in 2 years' time, it should at least be 20% of our deposit base.
Okay. Sir, on the cost of funds side, you're talking about replacing some of your earlier, borrowings which were at a higher cost. So, how much has your cost of funds come down, and in terms of your trajectory for margins from here on, what would you project?
So our cost of funds have come down around 2% already. From the original between 1.5% and 2% from where we started as a small finance bank.
Okay, Mr. Ghosh, good morning. Neeraj here, joining in this discussion as well. From an investor's perspective, trying to figure out how sustainable, how long-term would businesses like yours be, and how are promoters of these businesses thinking of how sustainable it is? Because the constant chatter is about MFIs and SFBs being acquired or merged into banks as well. What would your prognosis be? What's the kind of growth rate that you believe businesses like Ujjivan can show over a period of the next, say, 5 years? I'm not really talking about what's happening over the next 12 months.
Yeah, see, first of all, the whole proposition of small finance bank is that it is a specialized institution primarily focused on financial inclusion. That was what the mandate from the Reserve Bank was, So we are focused on this large segment of customers who currently get serviced from the informal sectors, or we are not, are not serviced, are unbanked totally. So that's our primary focus. And over 5 years' time, over a period of time, we feel that small finance banks will convert into large mass market banks, because that is a market which is currently unserved, which was supposed to be served by the public sector banks, but they are not serviced, for various reasons of their own, they are not able to service that market. So that is a market which is wide open, and I think in 5 years' time, that is the market which we will capture. That's the objective with which the Reserve Bank set up these specialized institutions, and that's our also objective from very start, when we started Ujjivan about 12 years ago. In terms of growth rate, we feel that we should be able to grow anywhere between 20 to 30% every year, year on year, for the next 5 years.
All right. Nobel laureate and founder of Grameen Bank, Mohammad Yunus, believes in the power of social business, not just financial inclusion. In a conversation with Bloomberg's Tamanna Inamdar, he says that forcing financial inclusion will not work. Listen to this slice of the conversation.
The social business is designed to solve problems. If people are in distress, if people cannot do something, do in a business relationship, maintain the business relationship, then something wrong with your design of that business, because social business has to come in a business way. So it's a question of how elaborately you have designed that. For example, just to give you a few examples, in Grameen Bank, if somebody is unable to pay, for crisis. We are always in crisis in Bangladesh because of the floods. Every other year, there's a terrible flood nationwide. Sometimes one part of the country is under flood. Nobody has mentioned that. It comes and goes. But people suffer. People lose everything in that particular. So we have a disaster policy in the bank. That the moment any flood in anywhere happens, the manager of the branch manager declares an emergency situation, disaster situation. And once he declares a disaster situation, his immediate job is to save people, use bank's money. So you can use bank money to save people, to take them to a safe place, to dry place, feed them, take care of them, everything out of the money. So this is built in, so you don't abandon them because they own this bank and they would have to do that. And then we go on, once flood recedes, our first job is to make them stand on their feet. Even they can earn 25 paisa a day, help them to earn that 25 paisa so that they start building their confidence to do that. You issue fresh loans for them. And when they go back, make sure whatever damages is done, it's a separate issue. We'll pack it up for a future repayment. It's a long-term loan. Don't worry about this now. Get started right now. Right now, they need the money. They have to be financed so that they can start. As soon as you can start, they can stand on their feet. As we keep telling them, if people stand on the feet, then Grameen Bank can stand on the feet. If people cannot stand on the feet, Grameen Bank is over. You don't have any meaning for that anymore because if you don't get the cycles of businesses and doing things, what is the bank doing for? So this is the end of it. So we built everything like that. When a woman dies, or one of our borrowers dies, whatever loan she owns is waived completely, right away. It's built in. You know that no family member will be responsible to pay back. So that's the end of it. We create pension funds so that when they go old, cannot work anymore, so that you can sustain yourself out of the pension fund. You create it. It's not somebody gave it to you. You create over the years a fund which will be enough, would generate income for you so that every month you get income out of the fund that you created yourself.
Mohammad Yunus there. Out of time on the show. Thank you so much for watching us.
Are we live?